Welcome to The Explainer. Today, we're unpacking a topic that is absolutely crucial if you earn money and travel across borders. We're going to demystify Indian income tax residency, clear away all that confusion, and help you figure out exactly where you stand. If you're an NRI, a merchant Navy professional, or honestly, just someone splitting their time between India and the rest of the world, getting a solid grip on this framework is incredibly empowering. Let's dive in. So, I want to start with a question that honestly keeps a lot of globally mobile professionals awake at night. Could India legally tax your entire global income? And I'm not just talking about the rent you collect in Mumbai or dividends from your Indian stocks. We're talking about your salary in Dubai, business profits in London, or investments sitting in Singapore. It sounds absolutely terrifying, right? Well, the answer to that question actually lies entirely, and almost exclusively, in exactly how many physical days you spend within India's borders. Here's our roadmap for navigating all of this. First, we'll look at the tax residency trap. Second, the golden 182-day rule. Third, exceptions and the 120-day rules. Fourth, special rules for seafarers. Fifth, the deemed resident clause. And finally, your actual tax impact.
All right, part one, the tax residency trap, and why counting your days matters so much.
Moving right along to part two, the golden 182-day rule. This is really the foundation of NRI status. A lot of people just assume tax residency is all about what passport you hold or your visa type, but it's actually a mathematical trap, and the only way to avoid it is through absolute precision. This rule is the bedrock of everything we're discussing today. 182. That's the magic number. Under Section 6 of the Indian Income Tax Act, you're generally considered a resident in India if you're physically present in the country for 182 days or more during a financial year. Keep your stay to 181 days or less, and you generally keep your non-resident Indian, or NRI, status. It is a very, very sharp line in the sand.
But notice I specifically said financial year. And honestly, this is where the first massive trap lies. In India, the financial year runs from April 1st to March 31st. We are strictly talking about this April to March window. If you're out there tracking your days from January 1st to December 31st based on the regular calendar year, your calculations are going to be completely wrong. Imagine celebrating New Year's Eve, popping champagne, thinking your day count just reset to zero, only to find out the taxman is still counting your days all the way until March 31st. No way you want that surprise.
When you visualize these residency rules as a flowchart, it makes a lot of sense. You start right at the top with that all-important 182-day gate. Did you stay 182 days or more? If yes, boom, you flow straight into the resident bucket. If no, you drop down into the different conditional branches. It's a super logical sequence to follow once you see it laid out.
But listen, even when you know the 182-day rule inside and out, it is so easy to mess up. One huge mistake is ignoring short visits. Let's say you have a long international layover in Mumbai, and you step out of the airport just to grab a quick coffee with a friend. Yeah, that counts. But the most dangerous trap by far? Excluding your arrival or departure days. Let me be crystal clear about this. The day your flight lands in India and the day your flight takes off. Even if you're only there for 2 hours before midnight, both of those count as full days of physical presence.
Okay, Section 3, exceptions and the 120-day rules, because sometimes 182 days is not the limit. See, the 182-day rule doesn't apply to absolutely everyone in a vacuum. A few years ago, things changed, and they added a whole new layer of complexity. The game completely changes if you hit this specific monetary threshold, 15 lakhs. If you're an Indian citizen or a person of Indian origin, and your income generated specifically within India, so we're talking Indian rental income, Indian business profits, Indian fixed deposits, if that exceeds 15 lakh rupees in the financial year, poof, that 182-day safety net just vanishes.
The contrast here is actually pretty shocking. For most NRIs, you get those 181 allowable days. But if your Indian income crosses that 15 lakh mark, your allowable visiting days drop like a rock. You now trigger residency if you stay for just 120 days or more in the current year, provided you've also spent 365 days in India over the previous 4 years. So you literally go from having nearly half the year to visit family or manage your business down to less than 4 months.
Let's shift gears to Section 4, Special Rules for Seafarers and Merchant Navy Taxation. If you happen to be working in the Merchant Navy, the standard rules have a very unique application, and it's designed specifically to protect your global income while you're out at sea. The crucial thing here is that a seafarer must be outside India for the purpose of employment for at least 184 days, or 185 days if it's a leap year. If you hit that target, you maintain your non-resident status, and your hard-earned merchant Navy salary stays completely tax-free in India. It's basically the inverse of the domestic rule, right? You're tracking the days you are definitively away working.
So how exactly do you prove those days away? It is all about the official stamps. If you look at a timeline of passport or continuous discharge certificate stamping dates, you can see exactly how the math works. For an eligible voyage originating in India, your period outside starts from the stamped departure date and ends on the arrival date. If you depart on July 10th and arrive back on September 25th, you're calculating those exact days in between. As a general rule of thumb for seafarers leaving for employment, the departure day is counted as outside India, while the arrival day back is considered in India. Precision with these stamps is absolutely your best friend. Moving on to Section 5, the Deemed Resident Clause, which is essentially an anti-abuse provision. Now, this is a newer rule. It was introduced back in 2020, and man, it caught a lot of globally mobile citizens completely off guard. It was designed to prevent tax abuse, specifically targeting individuals who shift their primary base to zero-tax jurisdictions, like the UAE, for example, just to completely avoid paying income tax anywhere. The rule basically says, if you're an Indian citizen, your Indian income is over 15 lakhs, and you are not liable to pay tax in any other country by reason of residence, you are automatically deemed to be a tax resident of India. And get this, that applies even if you never set foot in India for a single day that financial year. But hey, before you start panicking, there is a silver lining built into this framework. If you get caught by this deemed resident rule, or by that 120-day rule we talked about earlier, you are not treated as a normal full resident. Instead, the law classifies you as RNOR, resident but not ordinarily resident. And that specific classification is basically your financial shield. Which brings us to our final section, number 6, your final tax impact. What actually gets taxed?
Let's finally decode what all these statuses actually mean for your wallet. The distinction here is massive. Becoming a full resident, known as resident and ordinarily resident, or ROR, is vastly different from that protective middle ground status of RNOR. The labels might sound kind of similar, but the tax implications are literally worlds apart.
Here is the absolute bottom line on what gets taxed. If you become a full resident, ROR, your entire global income is taxable in India. Everything. The whole shebang. But if you hold RNOR status or the standard non-resident status, your foreign earnings are protected. Only your Indian income is taxable. So even if the new laws deem you a resident because you live in a zero-tax country, your RNOR status ensures that the salary you earn abroad remains completely untaxed by the Indian government. So what's the big takeaway from all this? You have to actively protect your status. Please do not rely on guesswork. Track every single visit cumulatively over the financial year, strictly from April to March. Always include the day you land and the day you take off as full days in India. And honestly, ditch the messy spreadsheets. Use automated day tracking tools or apps specifically designed for NRIs to ensure absolute accuracy. Precise day tracking is literally your best defense against accidental taxation. Which leaves us with one final, highly important question for you to consider right now. Do you know exactly how many days you spent in India this financial year? If you don't know that exact number off the top of your head, take 10 minutes today. Sit down with your passport, look at those stamps, and calculate your days. Don't leave your hard-earned income to chance. Thanks for joining me on this explainer, and stay empowered.